What do you think you've learned over the past year?
Tom, I think we both know that one has to be very cautious in saying one learns anything, because next year it might be that the opposite supposition comes to mind. But I think there are two features that stand out, and I'd be very interested how you in turn reacted to these. The first is that I spent a lot of time at conferences and the like hearing other investors talk, other investment institutions, many of whom I have in the abstract great respect for. But I've never been as convinced as I am that we're thinking about investment in a very different context. And with all respect, I think that just about everybody else finds it very difficult to get out of the narrow process of thinking about investments in terms of the modern portfolio theory, in terms of the agenda set by the CFA, in terms of the short-term pressures. So that would be one. The second, which I think is related to it and takes us closer to our day-to-day, is that I'm not at all sure that we shouldn't be more confident about expressing our belief that investing comes from involvement in the extremes, involvement in thinking about cultures, about big exponential opportunities in the long term. The Besson-Binder data that we've talked about elsewhere and which people listening can refer to seems to me absolutely compelling, and I'm amazed at how little engagement there has been with this. So those are the two factors that really strike me.
I think the focus on the extremes is something that I find hard, even having done a lot of work on it. You know, it is easy to be drawn back to, you know, what you might think is a balanced portfolio, or you know, thinking about risk in a different way. But it strikes me, this idea that you ought to focus so much of your time on things that could produce an extreme outcome, that don't have an attractive central case, if you like.
Yeah.
It's not the easily forecastable is of no interest precisely because it is easily forecastable. Extrapolation isn't interesting. So if you try to orient everything you do about trying to find that very small number of outliers, it causes you to think about things in different ways. You know, people ask about sell discipline a lot. Well, if what we're trying to do is find stocks that over the next 10 years will produce extreme returns, and they are the main driver of everything, then sell discipline almost doesn't matter. The things you get wrong become irrelevant in the context of the portfolio on that time horizon. But it really does matter if you sell too early a stock that is one of those real outliers. And so anything that you do that truncates the returns of the very small number of stocks is extremely damaging. So how do you capture that in process? And particularly at times when it may not actually seem rational to do otherwise.
Well, it was your times when it doesn't seem rational that I was going to pick up on even before you asked that question, Tom, because I think that applies to two elements which have been very prominent in the last year, and I suspect will remain so for some time to come. The first is at times of general market angst, and we know even if the market angst dissipates that the feeling of angst is preserved by market participants for a long period of time. And of course in those periods of market angst, actually that exponential success, that ability to own the extremes appears not to matter for a brief period of time because stock fundamentals are completely ignored in a period of panic. So I think that's one element of it. The other element of it, which I know has proven just how difficult this is to both of us in coping with what's gone on, though I hope we have coped with it, would be the Tesla example. Now, I think the accumulated stress coming from market participants, from the media, from the generalized and extraordinarily prevalent, this can't work, makes it very difficult to concentrate on, as you say, that possibility of the extreme, which has surely been present and remains present in every way. And it strikes me that one of the most pernicious elements, perhaps not the most commented on, but one of the most pernicious elements of the media coverage has been this demand for certainty. And indeed, at times journalists write articles criticizing our very acknowledgement of doubt. Now, I find that disturbing, and I do think that all the Rosling-type critiques of what attracts journalists are entirely emphasized and proven by this extreme case that we've been going through.
Well, I think I would link that to your earlier point about point one of what you've learned this year about our differences in approach to the way other people go about this task. And the one I find quite challenging on this is that if you look at these companies that have delivered these extreme returns, it's never been delivered consistently. Consistency is something that doesn't match with extreme returns. Instead, over long holding periods, you see them punctuated by periods of extreme doubt, of extreme poor performance. And actually, one of the things that's striking about Tesla is the poor performance of the stock has not been extreme. Compare that to Amazon in 2008, 2009, when the stock halved. Compare it to Illumina in 2011, when the stock halved. That you go through these periods of skepticism, and often if there is a real world driver of that, then it may be precisely in those time periods that the advantages of the company are becoming entrenched. It is in more difficult market conditions that the price proposition of Amazon, the difference versus others, becomes more important, and habits change. And so to the thing that I think people find very difficult is lots of people like to say they're a long-term investor, and then you look at the turnover in their portfolio, you look at how they behave, and actually enduring these sharp downdrafts in share prices is something they're very bad at, that you need to pull your horns in, you need to take less risk in periods of angst, whereas actually enduring as a sort of base case, and even being prepared to increase your positions during these periods is absolutely fundamental to benefiting from that 10-year return from these extreme outlier stocks.
That's right, but gosh, there's a lot to think about within that. Firstly, your comment that it's very often at times of stress, whether it be stress in the economy or stress in the individual companies or sectors, business models, is surely right. Looking back on 2008-9, the period of extraordinary tension in markets and tension in the global economy, many of our companies have in retrospect said that is precisely when their dominance was established, and it put out many companies out of business. My current analogy of that would less be the Tesla one in this case than perhaps what's going on in China. People have this insistence on selling Chinese assets because it must be awful, mustn't it? Tariffs, or isn't it catastrophic the growth rate might slow to 6%? Now, I think under those periods, that's precisely the sort of dislocation that actually probably works greatly in favor of the Alibabas, Meituans, Tencents of the world. So I completely agree with that part of it. Your comment about, though, not trying to be consistent is, I think, deeply, deeply important, perhaps to an even greater degree than what we've just been touching on there. This is Bezos's, we have to be willing to be misunderstood. And I think actually, when we both chat to Professor Bessenbinder, that's what we get back to, that it is extraordinarily dangerous to have companies who hit earnings points. A famous case in point, I think it's right to say that IBM has only missed earnings expectations 3 times in the last decade, whereas Amazon hit it less than half the times. But look at the relative share price performance. I think actually there is a lot of evidence that managing for the quarter is in itself inherently damaging.
Yeah, I totally agree. And if you further extend your example in Alibaba, they recently held an investor day, and there were hundreds of investors from lots of different investment firms coming to hear what management had to say. And an observation from the chat amongst the other investors was that there was a lot of encouragement to the company to generate cash. You want to be demonstrating to the market that you can generate cash. And this assumption that the market and that implicit in the question was what all investors would want.
And should want.
And should want, indeed. Now, if you look at what Alibaba has actually done over the past 3 years, it's generated a phenomenal amount of cash. I think of the order of $34 billion, and it's spent about $30 billion on it. Now, isn't that phenomenal? That you have a company with this type of resource to build out the consumer economy infrastructure in China, that it's not complacent, that it's not waiting for the next competitor to come in and invest and take share, that it's prepared to invest. It's probably an important part of its social contract with the government that it does invest. It's got to be cognizant of the environment that it operates in. But it seems to me in a period of massive change where you're still having these forces of urbanization, you're still seeing massive growth in consumption, that the opportunity is so big, you want to be spending now to take advantage of it. And the last thing it should be doing is giving the cash back to us to allocate to companies that don't have that scale of opportunity.
Yes, my response in your impressive sets of figures there would be I would possibly like that to be even more extreme. I genuinely believe that although one has to come up with one's own assessment of whether the possibility of this profit being reinvested satisfactorily, prosperously, and with high return is actually happening, that is part of our day-to-day task, that we should put that in the context that you are, not just the Chinese context, but a more general one. I do think there is a case for arguing the profit is what you get when you run out of ideas. And you also mentioned social contract. Well, you mentioned it in a specific Chinese case, but Tom, I press you a little in turn. Isn't this something that goes beyond the norm and shows how the mental habits of investment management firms are in themselves posing a great danger to the economy? Because I think that it is extraordinarily difficult these days for a company in the Western world, at the very least, to reinvest. There you were talking primarily about the influence of Western investors on Alibaba. I think it is a much more damaging and deep-suited force in the West. And, we need go no further than Tesla to suggest that's true. The notion that actually you might just need some capital to reinvent the car industry, or even at its most basic, to build a car factory, appears to have passed many investors by, and it creates outrage amongst the short community and their allies in the media. So I think we have a huge problem in the social contract that investors have in the Western world, in that the point of us having this gap capital is to create forward progress at the corporate and social and economic levels.
Yeah, a recent example of this would be Grubhub. So they reported their third quarter 2018 results, and they said, well, what the business does is provide a front end to restaurants for consumers to order food from restaurants, and then a back end infrastructure to deliver that food to customers. And that proposition is proving extremely popular with both of the communities. That customers love the convenience of it, they like the price. Restaurants like the extra business, and what we've seen in recent months is that Grubhub have been signing up big chains of restaurants that can't do this themselves, that want access to the network, and it's allowing them to grow the network out. And the results have been really strong as a consequence. And so the revenues are growing strongly, the business is doing well, and they came out in the third quarter results and said exactly that. And therefore, we are going to invest behind this opportunity. We're going to invest in marketing and building awareness of what we're doing. We're going to invest in the infrastructure to push further and faster. And the stock market's verdict is to knock a third off the share price. So there's no thought given to, well, is this attractive investment to be doing, or is it the cost of doing business? It's simply that there won't be as much immediate profit. And the malign consequence of that, I think, is what message does that send to the managers of these companies? If you're Matt Maloney, the founder, chief executive of Grubhub, what does that encourage you to do in future? I think, and that's why finding really special individuals that run these companies that have some mechanism for allowing them to ignore the short-termism of the market and the malign influence of some of these capital allocators is really important. It's can you find somebody that has the ownership and the control that allows them to ignore it? But also, how do we do the job of encouraging them to go down that route? I don't think any longer it's acceptable for us just to say, where long-term investors ignore the market and get on with it. It's making sure that you reiterate that message, because it's hard to counteract the impact on a management team or inside a company of the share price cratering every time they say they're going to invest.
I think that's absolutely right. And before trying to give some thoughts about what we have to do, what we should do to try and respond in those situations, a word or two on the European analogy, if you know of what you're talking about there, but with some twists that I think perhaps are dominant in the way that this has become a problem in Europe. And in this case, I include the UK as part of Europe. So in the case of Delivery Hero, which, as you're aware, is an internationally, in fact, a globally influential company in precisely the same industry as Grubhub, we got to a position where investors were, inverted commas, disappointed by the earnings. So not so much the supposition they're going to invest, but why wasn't there an immediate payoff to this? Now, the main answer appears to be because of the weather. Now, okay, one can keep checking that is the real explanation. But I think it is important, as you say, that you have not just the management, but the ownership and the support structures around that. So in one level, I think the management, particularly under Nicholas Osberg, is very prone to say, look, we will try and keep to the long run. But I think there is a miasma of other people surrounding the company, from their brokers to perhaps people with less determination inside the company to do that. So in that case, I think it's very important that the much criticised, I would say much maligned Oliver Samwer at Rocket, the original parent company, stood up and said, one summer is not relevant in thinking about where this goes. And I think that is important. And I think, having these bulk long-term shareholders is critically important. I think there is a great problem in the European context, in the UK context, about getting people to think about compounding and to think about the right metrics. A company we much admire, Spotify. So Daniel Ek is very happy to say, I believe that we are a mission-driven company with a long-term vision of where the music industry is going. The trouble is, as yet, the company hasn't really come up with enough metrics to make it judged on those scores. So I think our role in that case is to pull them up on this in a hopefully very supportive way and say, if you're asking us to view it as a long-term transformatory project, you've got to give us some clues about what are the relevant metrics on that, because they sure as heck aren't quarterly profits or even quarterly subscribers in terms of your influence on the music industry, how you want to alter the mentality of the artists, the consumers and the labels altogether. I think that we need to try and encourage both ourselves and the outside world to be more thoughtful about what therefore are the relevant metrics. You know, it's not good enough for us just to complain, if you like. It's to say, hey, a PE multiple for the next 2 years is really not a good way of assessing this company.
Yep. Yeah, I completely agree.